the 20-week cycle. Okay, let's have a look at the 20-week cycle VTL, and let me just show them to you one at a time, because they are all getting a bit messy. There is the 20-week VTL. So as you can see, it's going to take some time before we get confirmation of at least a 40-week magnitude of trough from the VTL as well. Now, what about the 18-month VTL? Let's keep zooming out, and 40-week, I forgot about the 40-week. And let's go back, let's see if there is a downward pointing 40-week VTL. No, there isn't. As a matter of interest, why isn't there a downward pointing 40-week VTL? Well, of course, the downward pointing 40-week VTL would connect the two most recent peaks, consecutive peaks. There's the one peak and there's the previous peak. So a downward pointing VTL would need to be drawn like that, which you will notice, of course, is not downward pointing. So it breaks one of the fundamental rules of a VTL, that a downward pointing VTL needs to point downwards. So that's not a genuine VTL. So there is no downward pointing VTL to provide us with information about the confirmation of the 18-month cycle trough. And finally, let's look at the 18-month VTL. There's a little interesting sort of discussion to be had about the 18-month VTL. Here we go. Let's look at it on a weekly scale, and let's zoom out a little bit. Now, the two most recent. Let's put the semicircles on again. No, that's a bit of a mess. The two most recent 18-month cycles. Sorry, let me say it again. The 18-month VTL should be connecting the two most recent 18-month cycle peaks. Right? That's what an 18-month VTL is. So now the most recent 18-month cycle is this really quite visibly evident cycle here. Here is the peak. Okay. Then the 18-month cycle before that is this one over here. There is the peak over there. So surely the 18-month cycle VTL should be drawn between those two peaks. Okay? Most people would think that is the 18-month VTL, downward pointing VTL. Why has Sentient Trader drawn it somewhere else? Well, because this VTL over here that I've just drawn in a big fat red pen breaks one of the fundamental rules of downward pointing VTLs, which is that the trough in between the two peaks, and there's the one peak and there's the other peak, the trough between the two peaks may not be of greater magnitude than the cycle upon which the VTL is based. And this trough over here, I've drawn over it so you can't see it anymore, but that trough over there is of 4.5-year magnitude, so it breaks that fundamental rule, which means that this is not, in fact, a valid trend line. Okay? That's why Sentient Trader doesn't draw that line. Why does Sentient Trader draw another line? Well, because when it cannot draw a recent valid trend line, it draws an old one, even though that is what Sentient Trader refers to occasionally in the commentaries as an expired VTL. It is expired because, as you can see, price crossed it over here. When price crossed that VTL over there, that provided confirmation that this trough was of at least 18-month magnitude. Okay, so in the constantly evolving puzzle of performing a cyclic analysis on this market, this VTL, although it is slightly old information, is nevertheless interesting information to be presented on the chart, and it does provide you with an understanding of why this trough here must be of at least 54-month magnitude, because the 18-month VTL was crossed. Okay, by price. So it provides you with some sort of extra information just by looking at it. You should never really just take an analysis that Sentient Trader performs at face value. The more you can explore the analysis, the more you can understand it, the better, I believe. I'm very proud of the analysis Sentient Trader performs, and it consistently performs pretty good analyses. But that's no reason not to look at it and think about it and criticize it if necessary yourself. You should perhaps the best word to use is you should interrogate analyses. I believe you should interrogate any analysis that Sentient Trader performs. Question it and look at it and see if you agree with it. And of course, the more confident you are in the analysis that has been performed, the more confidently and successfully you will trade on the basis of that analysis. That, therefore, is my presentation of what's happening in the euro to US dollar at the moment. What's happening sort of really short term? Well, of course, we're expecting the euro US dollar to move down into a 20-day cycle, which looks as though it's been doing this week. And the 20-day cycle we would expect any time now, as you can see from the circle and whiskers at the bottom of the chart. The 20-day cycle trough is expected anytime from, it was expected anytime from Monday right up until the 9th or 10th of February. And the exact date at which it is expected is the 5th of February. Of course, the market is never exact. It makes it so much fun. So it's unlikely to happen exactly on the 5th of February. But anyway, we are expecting the market to move down into a 20-week cycle trough, after which, of course, it will bounce up again and then come down to a 40-week cycle trough somewhere over here, as can be seen towards the end of February. So tune into the ST Outlook, which you can read, of course, on our Sentient Trader website. This Saturday, I'm writing about the euro US dollar, so I'll be giving more detail about what we can look forward to over the near term. I thought I would, if anybody's got anything to say about the euro to US dollar analysis, I'd love to hear about it. I thought I would mention something that I've noticed between the euro US dollar and the S&P 500. And I've spoken to some Sentient Trader users who I know have also use this sort of approach. So I thought I'd bring it up. And that's an interesting thing that tends to happen between the euro US dollar and the American market, the S&P 500, for instance, or the Dow. But in this case, I'm going to look at the S&P 500. And that is how the cycles tend to be moving with some degree of consistency or harmony between the markets. However, the positioning of the actual major troughs often tends to be either 80 days or 20 weeks out. Let me demonstrate what I'm talking about, and I'm going to start by taking a look at this period in 2008-2009 to demonstrate what I'm speaking about, because I think this demonstrates something really interesting about ways in which one can use Hurst cyclic analysis to get a better understanding of what's actually happening in the market. Let me just change this to a daily chart. What I'm going to try and do is create a zoom that is equal between the euro to US dollar and the S&P 500, and then we'll compare what happened between July of 2008 and let's make it July of 2009. That's what happened in the euro to US dollar. According to this analysis, the 18-month cycle trough occurred towards the end of October. Okay, then in March, in fact, the 4th of March to be exact, the euro to US dollar formed, according to this analysis, a 20-week trough. Okay, let's measure the length of that trough. It was 18.3 weeks, a very average length 20-week trough, which of course nominally we expect to be 17.9 weeks or something like that. Anyway, it's roughly 20 weeks, and so there are 20 weeks between those two troughs. Now let's take a look at the S&P 500 at the same time period, July 2008 to July 2009. And with a bit of luck, I've left this chart. No, Let's find it, 2008 to 2009, and so I'm going to try and get exactly the same zoom. 2008 to 2009. This is an analysis of the S&P 500, which we spoke about last week. As you can see, it's got a 6-year cycle in there, a non-harmonic, non-perfectly harmonic cycle, 6-year cycle, which is why that diamond is floating there. But nevertheless, if you can ignore that for now, this is the same time period. And so let's find those troughs. The end of October, there was a trough in the euro to US dollar, which turned out to be the 18-month cycle trough. Where was that here on this chart? It was, in fact, over here. Okay. You'll notice something interesting happened in the American market. The euro to US dollar formed an 18-month cycle trough and then took off, of course. The American market stumbled and came down in mid-November, where an 80-day cycle trough was formed over there. Then what about the March trough we saw in the euro to US dollar? The 4th of March was the date of the euro to US dollar trough, and that was the trough of the 20-week cycle. Of course, on the 6th of March, 2009 is the by now famous, I believe, 18-month cycle trough at least, possibly even 6-year, but that's a separate discussion. But there is a trough of at least 18 months, okay, which occurred in March. So an interesting thing is happening. This is just one example. I'm going to show you 2 more examples. And an interesting thing is happening between the euro to US dollar and the S&P 500. The cycles are moving in harmony. I think you will agree. But there is a displacement occurring between them. It's something that I learned. I started practicing Hurst cyclic theory when I lived in South Africa, and I was trading the South African market. And I would analyze the American market, and then I would analyze the South African market. And I got very used to the fact that if the American market formed a really big cycle trough, such as an 18-month cycle trough, then the South African market would often form a similarly large cycle trough, but often displaced by either 80 days or 20 weeks. Of course, the next question is it always displaced in the same direction? And that is the fascinating thing, because I believe the answer to that is no. I believe that sometimes the displacement in one market it happens later, and sometimes in that same market it happens earlier. So there's a very complicated thing happening with all the cycles, and it's like a really complex puzzle one's trying to untangle. But they're all moving with some harmony. It's Hurst's commonality model idea. They're all moving with some harmony, and major cycle troughs tend to occur at the same time, such as in October this year. October last year, we saw a trough that was definitely of at least 18-month magnitude in many markets. Some markets it was of only 40-week magnitude, and in the euro to US dollar, as I have been saying, of course, I believe it was of even greater magnitude. Let's zoom out here and take a look at this period here. From 2003 to 2004, because there's another example of this sort of displacement of these troughs. Let me look at a slightly longer time period.